So IPO, what can we say? It's been the flavor of the season for quite a while now, right? And looking at the Bajaj Housing Finance IPO that just concluded, I think that is when you really know how much money is actually there in this country. I actually can't believe 3 lakh crore was actually locked up in that IPO.
It's 1% of GDP.
1% of GDP. That's crazy. Yeah. So I'm going to jump right into the question, cut to the chase here. So today, when people think about IPO investing, they usually think in terms of getting an allotment and then on listing day or a day after that, selling it for some big gains, right? Now, this happens, sure, but is this a reliable strategy for some normal retail investor to actually adopt?
Before answering that, we have to understand the story behind cult of IPO investing.
Okay.
So popularity of IPO investing goes back to 1977. 77.
Okay.
Yes. When then Janata government forced MNCs to dilute their stake in local entities and list on stock exchanges. Believe me, they didn't want to list. Okay, they have sufficient money, but government forced them to list. Okay. And issue price that time used to be decided by Capital Controller of India, a government body.
Not the company.
You cannot decide your share price.
Okay.
Government body used to decide it for you.
Okay.
And that used to result in significant discount to actual value of the share. Okay.
Not the potential also, even the current value of the company.
Had the company been already trading on the stock exchange, it would have a real price.
Right.
Typically, IPO price used to be a significant discount to that real price.
Wow.
And when I say significant, it's 60 to 70% in some cases.
60 to 70%. That's
some cases. So flipping gains that you see right now are legacy of those memories. So let me give you an example. Like Ponds was a household name those days. It was already in existence for a few decades.
Yeah.
Okay. The face value of the company was 10 rupees. Okay. And issue price after market leadership of few decades was only 20 rupees. Okay. 100% people got allotment. Okay. As equities were not very popular those days. Okay. Stock price jumped to 100 rupees on listing day.
Wow.
Okay. And in 3 months it reached 350%. So people made cool 16x.
16 lakhs in 1977. It's like crazy money.
Yeah.
Wow. Okay.
So most of the IPOs that happened those days used to return in strong long-term, I would say huge long-term wealth creation for investors.
Right.
So people were, when we were investing in IPOs, they were like the business owners who were buying the company at a significant discount.
Correct.
So it was a once-in-a-lifetime opportunity to get a slice of a well-known brand.
Correct.
It used to be like that. A lot of big companies went for IPOs those days. Okay. Colgate went for IPO. Okay, so a lot of these are all well-known brands, and you're getting it for peanuts. So it was like a business owner sort of mentality that I'm getting it dirt cheap. I will keep it for 10, 15 years, and then I will sell it. I will sell it at 20x, 30x, 50x.
Right.
Okay, that was the mindset. Okay.
Right.
And IPO. You see IPO craze these days, and people talk about how the IPO bubble is there. People are crazy about the IPO. There is a lot of publicity around them. It's nothing.
Craze is nothing.
Nothing. It's nothing. In 1992, Capital Controller of India was abolished.
Okay. Post-liberalization.
That entire body was gone. Okay. And prices used to be, it was stipulated, the prices would be decided by issuer himself.
Okay.
Issuer would decide. And there was simply no entry criteria. Any corporate, any kirana store, anyone can just go and do the IPO.
So it's like a complete swing.
Because SEBI just came into being. Regulations were quite light at those days, during those days. They were just figuring out right way of market regulation, just figuring out.
I think they were a non-statutory body at that time, if I remember correctly, when they just came in.
No, in 1992 they got it was made through Parliament Act. So I think they had all the powers, but they were still figuring out.
But this is a 180-degree shift.
And there were 4,000 IPOs between 92 and 96.
4,000. In 4
4,000.
years.
4 years. And lot of people lost money.
Because anybody can go
Anybody,
for
there were some crappy businesses coming, getting listed on exchanges. Okay.
no eligibility criteria.
No eligibility criteria is there, and even those crappy businesses were not available to discount. That used to be earlier available when Capital Controller of India was deciding the prices. So forget about the long-term returns. Even listing the returns were not there. So initial stages, because IPO used to enjoy good reputation. Initial stages in 92 and 93, they used to be great returns. Okay, and people got really overconfident that every IPO gives returns.
Gives returns, yeah.
So people started to apply for IPOs in hordes. Okay, and a lot of crappy companies got listed there, which should not be there ideally in first place.
So in 1977, you have a situation where even a market leader for a few decades is crazily undervalued.
Undervalued, yeah.
And in 1992, you get into a situation where even a Kirana store can go into an IPO.
And they are also getting same flipping gains.
Right.
Okay, same flipping gains, and there was a tradition those days to hold the company for next 5-10 years because it was coming from the legacy of those Janta days.
Correct.
And so people used to hold the stock after that. Flipping gains, typically nobody used to book flipping gains. Flipping gains were not that popular.
Right.
Okay. And company used to get bankrupt after a few months. Okay. And then SEBI introduced a lot of regulations. Eventually, okay, there was a condition about the being profitable for last at least three out of last 5 years, with minimum profit of 15 crore has to be there. Also, earlier IPOs were all about retail investors. Okay. Now 50% allocation has to be done to institutional investors. Okay. Now institutional investors are big investors. They will not waste their money.
That's smart money, right?
That's smart money. So they will not invest in a crappy issue. They would go for a big issue. They will go for a good issue. Okay. And they have research power. They have research capabilities.
Correct.
Okay. They take seat on the board also. So it also improves the corporate governance. Okay. So basically, institutional investor is now taking the lead, and retail investor is just co-passenger, benefiting from the
good for a retail investor.
Yeah, it's a good for retail investor
because those institutional investors act as a good indicator of the quality of the issue. Okay.
So the fraudulent IPOs that we saw in early 90s, in the mid 90s, they kind of disappeared. So right now, quality of issues are not bad. The main problem is the valuation.